Today we're going to be talking about beyond the core four, which is looking to expand your commercial real estate portfolio beyond just the regular commercial real estate asset classes that a lot of us know very well. But I've been working with Equity Multiple going on about 3 years now. And through that time, we've done a lot of different deals, a lot of different asset classes, and worked with a lot of different investors. But I want to give you just a quick background on Equity Multiple, and we'll talk through commercial real estate as an asset class very briefly. Some of us may be more familiar than others, but I'll give a brief overview just to give us a solid foundation. We were founded about 10 years ago as Equity Multiple, with Charles Clinton and Marius Schulson being the co-founders. Charles was a private funds lawyer at Simpson Thacher. He was working on large transactions for the likes of Blackstone, KKR, really big deals, and he really saw the wealth building potential of commercial real estate. When he wanted to then invest his own money in commercial real estate, he really found that you couldn't. Some of the deals were in back rooms between private parties. He wanted to invest in a building here in Brooklyn, and he just found that he couldn't. It was just traded too fast. So what he did is he teamed up with Marius, a friend of his, and Marius was really deeply entrenched in the private funds world, private credit for real estate, private equity for real estate. And they formed this platform for accredited investors, self-directed individuals to hop on, find vetted, curated real estate investment opportunities and invest and manage that all within one streamlined platform. But what is CRE and what are the core four? Maybe we start there. Private market commercial real estate is exactly what it sounds like. It's real estate held for a commercial purpose that's not traded on a public exchange. So most real estate is going to be a private market asset because there is no centralized exchange for real estate assets. It's not like a stock where you can sell it on the stock exchange within minutes. This is a slower moving asset class. And with the commercial real estate part, a lot of people think commercial just means retail or industrial. But commercial real estate also includes apartments and multifamily buildings, those that are held by a business to turn a profit on that real estate. The core four is going to be real estate that encompasses the largest types of real estate transactions out there. We like commercial real estate. We like private market commercial real estate particularly because it really gives you that tuning of your portfolio. On the left-hand side of your screen, you see that we've got the classic risk and return chart that some of you might have seen before. What this does is you see that on the bottom row of investments, you've got just equities and bonds. And on the top row, you've got equities, bonds, and a mixture of alternative investments that you can include. So adding alternatives helps to drive less potential volatility in your portfolio with increased amount of return. So you're really able to dial in that risk and return profile that you're looking for. You also see that commercial real estate is driven by real demands in the economy. On the left-hand side of your chart, you can see real GDP for the United States versus the returns for direct real estate. And although there are some significant volatility spikes, notably the global financial crisis when real estate really was the star player in the downturn, and then the global pandemic, and aftermath when we saw some real estate valuations pop. But overall, you see that commercial real estate, direct real estate returns tend to ebb and flow with the economy and provide an extra amount of return over just the general growth of the economy. And on the right-hand side of the screen, a lot of investors know that real estate is often a very good hedge for inflation. So in high inflation and rising inflation environments, you see real estate perform fairly well. It keeps up with inflation, is seen often by a lot of investors as an inflation hedge. So you get really attractive returns that can increase with inflation, returns that can increase with the growth of the economy. And all the while, it's a stable and tangible asset class. It's a real piece of property. It's a real building. So it's not just going to disappear in smoke like GameStop. The core four, as I talk about, are the four largest asset classes in commercial real estate, namely multifamily, industrial, office, and retail. It used to be office was the largest asset class back in the heyday of big industry, but we've seen that really ebb away as a lot more people have, returned to doing a lot of work from home, hybrid, and just not needing as much office spaces anymore. A lot of outsourcing as well. So really what we've seen is a big rise in industrial, a lot of manufacturing, warehouses, rise of e-commerce really driving that, and multifamily remaining and growing as a very strong asset class. They're really core to the economy. Obviously, they're core to a lot of portfolios when you look at a diversified real estate portfolio, but they're not the only thing that's out there. You also have access to a lot of other asset classes and sub-asset classes within these core four. So here just emphasizes what I was talking about before. In the pre-global financial crisis era, you can see office dominance in terms of transaction volumes for office. And then post-GFC, we see a lot more growth in apartment. And there's somewhat of a housing shortage in the United States, somewhat of an affordability crisis when it comes to single-family homes. So apartment and multifamily has become, much more attractive for people, both on the renting side and the building side, because allows people to build at scale and provide a lot more housing for people. So the benefits of investing in the core four, obviously, it's the largest types. There's, potentially more liquidity. There's a lot more demand. They are key to the economy. People need places to live. Goods and wares need places to be stored as well. And a lot of investors, I think, understand these asset classes. You know how to value a multifamily property. You can understand potentially how to value a retail space or an industrial space. And one of the benefits, which might even shift into the drawbacks, is there's stronger institutional demand. Blackstone can scoop up a lot of these assets. There's goes hand in hand with that liquidity, but they fall short because of just that. They're very crowded markets. Everyone's fighting over the same large industrial spaces or the same large, signature multifamily developments. And although they are key to the economy now, what we're seeing with a lot of office space is that they're very rigid. It's really hard to refit those spaces into something that might make more sense for now in the economy. Maybe refitting to multifamily, or even more crazily, trying to refit that into urban farm space. I was reading about that recently. And because of the crowded, tight markets and understandability, they're typically lower sponsor or management edge that you can get. You're not really getting as much alpha. If everyone can understand what the value of a building is, it's really hard for you to be different and right at the same time, to quote Howard Marks. So how do we look to add more to our portfolio? What are we going to do to maybe get a different edge, maybe add a bit more flavor? And that's where we go beyond the core four, the subject of what we're talking about today. I want to take a pause and say, I don't think that any of these, other asset classes should be the whole amount of your portfolio. I think that just like you have a ballast of public equities, a ballast of public stocks and bonds in your portfolio, you want to have a ballast of core real estate positions as well. You want to stick to things that you know are going to be core to the economy going forward. A good set of multifamily, a good set of industrial, and things that are going to provide some stability in the portfolio. Diversifying and adding additional asset classes beyond that, or slicing down to the sub asset classes, allows you to get that niche exposure. And you get that through emerging asset classes and asset classes that have become more attractive as the economy evolves. One of the biggest things, at the top left here, we've got Campground. During the COVID-19 pandemic, obviously hospitality took a hit, but what were people doing instead of going to hotels and big resorts? They were going outdoors. They were going camping. So we saw a big influx of campground asset classes, which really provided a differentiating asset class during COVID, because they saw the rents and the income from those properties really spike. Similarly, you get some differentiated asset classes that are maybe acyclical, moving down to self-storage. That's what we see across the different economic cycles. In down periods, you get people that are maybe downsizing their apartments. They need a place to store their extra stuff before they move to a smaller apartment. So they need a self-storage container. In up economies, maybe you've got people that are moving to bigger apartments and more buying bigger recreational equipment. They need a place to store that kayak or their bow, or whatever they're using for their outdoor activities. And across both of those, and regardless of where the economy is going, people are always going to be moving around. And self-storage gets a lot of knock-on fees due to moving expenses. Have a U-Haul that's there. You've got moving supplies that are available. So self-storage tends to be fairly acyclical, not really prone to the same ups and downs of the cycle. On the right-hand side, we get a little bit more differentiated stuff. I mentioned medical office as a separate one because it has some special outfitting. And I mentioned about how office overall is fairly rigid to changes for things like regular apartment housing or change to just retail. But it does still have uses as maybe alternative tenants putting in medical offices. And we're seeing the medical industry really explode. So catching those secular tailwinds, catching those cyclical tailwinds, and grabbing onto trends that we're seeing in the rest of the economy can really help you expand your portfolio and get those differentiated returns that you might see in these alternative asset classes. Specifically with medical too, if you've dug deep into the jobs report like I did when you nerd out about employment, you see medical field really being one of the largest employers keeping up the growth in the jobs market and the economy. So we're seeing a lot of different asset classes, and each one of these, you can slice and dice how you can tune your portfolio for the thematic range of options when it comes to returns. And then in the middle there, of course, we've just got, things that are smaller types of asset classes that are just, not as big as retail, industrial, and multifamily or apartment, but are still core to the economy. Hotel tends to be a lot more cyclical. You see a lot of spikes during intra year, like you see hospitality season, but then across the business cycle too, you're going to see a lot of spikes and troughs, and it tends to be a lot more sensitive to occupancy as well. But there's still a place for something like hospitality in your portfolio, especially if you're tactical about it and choosing it for the right aspect. I mentioned that some of these are truly different asset classes and some are sub-asset classes. Student housing is a sub-asset class of apartment. It's still apartment, but it has some unique occupancy and rent dynamics that make it more attractive or less attractive versus just regular apartment. In college towns, obviously, you're going to want to buy student housing because students have to live somewhere. But in a place like New York, there's not as much student housing, so it doesn't make as much sense. So I think that you can find a reason to buy some of these asset classes in a lot of different markets, but you have to understand what those markets are and how they're going to behave. So I think when we talk about the advantages of these overall for the different sub-asset classes, they're a bit of a complement or the opposite of the drawbacks for the core four itself. There's obviously less competition. Blackstone and KKR, their ballast of investments for their portfolio is going to be an apartment. They're not really doing a lot of hospitality or campgrounds or car washes for that matter. And some of that's because it's not in their wheelhouse. It's not what their focus is. But some of it is because it's just they're much smaller deal sizes. Blackstone and KKR, they're going after hundreds of millions of dollars per deal, whereas EquityMultiple, we're going after sub $50 million per deal. So, we're able to extract a lot more alpha because there is not as much attention on the types of deals that we're going after. You're also getting a lot more fragmented deals. I mentioned that what I often talk about with investors is you have an asset class and market pairing. The toy example I give, which is a bit glib. You're not probably going to want to invest in a senior living facility in North Dakota, but you probably do want to invest in a senior living facility in Florida because that's where a lot of people retire to. So that locality of sponsorship, that local knowledge, really getting very granular with the data, really provides what we see as an ability to extract extra alpha or that alpha advantage from those properties. As I've been hammering a lot, obviously you get the diversification benefits of just getting something different than the core four. And like I mentioned with self-storage, you just get different cyclical exposure as well. And, these are just an example. These 6 that I've highlighted are something that we've done a lot of at EquityMultiple, but there's potential for new asset classes every day or things that we haven't even considered. One of the most popular that people want to get into is something like a car park, literally a parking garage where people park their cars. It's a very simple business model. There's not much maintenance required, and people literally give you their money to leave their stuff on your property. So it's a fairly simple business model. You also see maybe boat slips as another one. And what we'll get into is another differentiated asset class that I'd like to present at the end here as well. This is a lot going on. I hope you appreciate the charts. These are from JP Morgan, but these are all the different sub asset classes for real estate. And, when I was working in wealth management, advising on, corporate retirement plans, we used to show this type of chart and show that, the one that's on top is never the same. The one that's on the bottom is never the same. You see a lot of volatility when it comes to the different asset classes outperforming each other. And what I've done is I've highlighted what the core four look like in terms of the 10-year total return and the volatility as well. And we can see is that, they are not the top performing. They're not the worst performing, but they are a blend of the performance across all the equity. And what we see is you've got a lot of other asset classes that are in there that are a much smaller portion that can provide potential different diversification and just different access to the properties over time. Overall, real estate has performed fairly well, with the volatility being, about in line with the S&P 500 for an equity rate. So where do we access this? I mentioned this or teased this before about the middle market, and EquityMultiple, other platforms like that, like us, are going to play in that $5 to $50 million space. With bigger deal sizes than you might do as an individual investor, but smaller than what the big managers in the world are doing. So we get more tailored investments, local markets. We get maybe bespoke lending when we're lending out our money. And it's big enough for us to provide an edge as a professional manager at scale, but small enough for us to be really nimble when it comes to putting capital out. And overall, that's where I think you can get a lot of alpha potential, is combining these niche asset classes and diversification with a middle market advantage combined together to really provide a bit of alpha for you. I'd like to pause for questions, maybe Chris, and then I can go over one of the deals on our platform if that would be helpful. That talk through a case study of what we're seeing for something beyond the core four.
Awesome. Thank you, Daniel. Yeah. And as you mentioned, please do drop your questions in the Q&A. We'll work to get to as many of those as possible. So many questions here that we could get into. If you don't mind going to the slide with the different asset classes that you're providing access to. So first up, would love to understand a little bit about, like, when you say you can invest in campgrounds, one, with these kind of unique asset classes you're going into, is this through a fund? Are you getting, 10 campgrounds in one, or are you doing individual projects? And then the second thing I'd love to understand is, like, what does this look like? Is it equity? Is it debt? Is it a mix thereof? And are you bringing in an operator to run this campground, or how does that work?
Yeah, all good questions, and we'll get to those in order. So for EquityMultiple, the majority of what we invest in are direct real estate investments, meaning one investment goes to one property. We have done some funds in the past, and I've got an example at the end of a fund that we're looking at right now. But most of the time, it's going to be one investment into one asset class as just an SPV entity. Some investors want to just get general exposure to commercial real estate or general exposure to specific asset classes, diversify their risk. And that's fine. For the types of minimums that we have, though, I think it really allows investors to put together a more bespoke portfolio. For $100,000, you can get access to 4, 5, 6 different investment properties. And it's not like a big fund, but you're building a nice portfolio for yourself.
Yeah.
In terms of the capital stack position, we invest across the capital stack. And that's, I think, one of the other differentiators for us here at EquityMultiple is that we're not just looking at equity. We're not just looking at debt. We like to, see what the best capital that we can put out is for the specific type of property. So we've got investments that are income, debt or preferred equity or mezzanine debt. And we also have some equity investments as well. And across these 6 asset classes, I think that we've done both debt and equity across our 10-year history in each one of these.
Got it. And then in terms of, like, for campgrounds, for instance, this is one that I don't know very much about. Are you bringing in an operator to run the campground?
Yeah. So that's the other thing is we are not a manager ourselves, right? We're not the smartest on every single one of these asset classes. we partner with local sponsors to they either buy it or we're lending them to buy it. Uh, uh, and then they will operate that or hire a property manager themselves, just like you'd hire a property manager potentially for a large multifamily building. And for something like Campground, I think something that's interesting that I didn't really even realize about Campground is it's not just always camping slips that people are out renting out. In the off season, they'll also rent it to more long-term tenants, like almost like a mobile home park. So you're getting multiple revenue sources. You're sort of evening out that cyclicality, and it's something that I didn't know coming into real estate, but it's something that a smart real estate sponsor that you can partner with through the connections that we've made to understand that you can hand off the trust, hand off the keys to someone to manage it on your behalf.
Got it. And one last question on the campground piece. When you're sourcing campgrounds, one, are there very specific experts within this field? And then as you think about, specific risks to something like campground investing, like how does that differ from, investing in multifamily homes and things like that?
Yeah, I think a lot of the due diligence is fairly similar. The principles of due diligence are similar across all these asset classes. You want to have third-party reports where available. You want to do comparable analysis in the locality and the location that you can. You want to get as much information about the asset class and the things that can go wrong in that asset class as possible. So all those principles apply across the board. There are I think people are fairly familiar with something like the MLS or Zillow or finding comps for multifamily or apartments or even just single family. But you might not be familiar that there's whole data sets of comparable transactions for all of these sub transactions as well. So there are specific databases or brokers or research services for campgrounds, for car washes. And there are even specific companies that will do third-party valuations or third-party analyses for very specific things. I mean, there's a whole trade magazine related to and trade journal related to car washes specifically. I actually had an interview with Car Wash Magazine just this week. So that's the other thing too, I think, is with the additional asset classes, I totally understand. It's a lot more complexity in terms of the investment decision-making process. And, what we've tried to do is take some of that, analysis on our own and packaging it into a much more digestible format. But I think it is the due diligence process that we do. It does take into account a lot of the information that you would do on a regular office building or do on a regular multifamily building. It's just different data sources that we plug in for campgrounds, hotels, car washes. Specifically, something like hotel. Most people are probably aware that you give the money for a room, you get a room, and that's sort of like the daily rent that you're paying. The other revenue stream for something like a hotel is, the food and beverage or the conference fees, or so there's a lot more revenue streams than just the daily rent, or even what I mentioned with the campground or self-storage. There's a lot more revenue streams than just buying a slip for a week or a self-storage buying a self-storage unit for a year, whatever the lease is. So I think that's where you have to get a little bit more nuance with the underwriting, is understanding that there are a lot more potential revenue sources, and then also, trying to understand the costs and the comparables.
This is just me assuming, so I could be incorrect here. But when I think about things like campground, car washes, the other, larger, and there's large businesses within them, but with campground, the car washes, I see it more as, individual proprietors and things like that that are potentially involved with this. Because of that, I imagine there's less lenders and investors in these specific markets. Does that lead to opportunity for higher potential IRR on deals like this? Recognizing there's more risk in all of that, but do you see that, or what are your thoughts on that?
Yeah, I think going backwards, the higher IRR, there's potentially less liquidity, right? Not everyone's turning over campgrounds every day like you're turning over
Right.
apartments every day. But within that, there is a lot of alpha potential, like I talk about, because you're able to pick up that asset class, especially if you're lending out to these asset classes. Not many people are maybe willing, not many banks are willing to understand that collateral fully because it just doesn't fit their business model. Again, this is not
Right.
saying that a bank is passing on this because it's a bad deal. It's passing on it because it doesn't fit their machine. So if it
Yep.
doesn't fit the machine, they're just not even going to run it through the machine. So for us to take the time to understand the asset class, to partner with experts, third party reporters, and really get a good sense of this. And our asset managers, I think, have been through enough of these where they do have a good sense of what makes a good deal or what makes a bad deal in this specific type of asset. Um, and I think that extra effort is the alpha potential that you get.
Hmm. Yeah, absolutely. Going to medical offices, one of the challenges I've seen in the market, it's certainly something I've paid a bit of attention to. Um, Sometimes with these custom fits and having it designed for specific purposes, if it's not already leased out, there's the risk of them sitting empty for a while. I know there's actually a building right near my office that has sat empty for 3 years. It was extremely custom, and then the biotech, their funding ran out. Um, when you're looking at medical offices to invest in, are you looking for the occupancy to already be, at 80+%? And how do you think about that in your diligence process when you decide to invest?
Yeah, so I think it's partly looking at what the market occupancy is, right? If no office is above 60% and you're able to get an office for 70%, that's probably a pretty good spread, right? Your occupancy is more stable than the rest, and the valuation is going to reflect that. The other thing that we've been looking for specifically with medical office is we did a non-performing loan acquisition. We bought a bad note from a lender, then we acquired the property through a UCC foreclosure.
Hmm.
And what the sponsor did there is they already had connections with NYU Medical, with Langone, with North Shore Long Island Jewish here in New York. And they already had that plan. They're like, hey, you guys are looking to expand. We're going to find a space. Like, let's make that happen. So they already had the pipeline of people looking for that type of space. They just needed to find the property to then source or pipe that demand too. So I think that's where we go from it. It's not as much that we say, top down, we want to invest in office, go find me office buildings. We're looking at sponsors who are very patient in trying to find good deals, and they wait for the deals to come that have a lot of shots on goal that you can take, which have a lot of potential mitigants for the risks in it. And it's less about the lease up for these niche asset classes and more about what's the inefficiency that we're closing the gap on.
Hmm.
Something like apartment. I mean, if your occupancy is 95%, yeah, you can increase the 95, but that, you can turn over tenants and maybe just be more aggressive with the rent pushes for the next turn. For something like a car wash, you're going from 0 to 1, and it's more looking at, hey, there's no car washes in a 5 mile radius. Why don't we put a car wash there? Or for medical
Hmm.
office, like we have this set of clients that want medical office. We've just found this, really empty place. Well, let's just plug them in and just be good there.
Interesting. On student housing, I'm trying to understand the profile of what student housing looks like. Is this where a school is employing you to build a building that they then rent out and charge all of these students to stay in? Is this off-campus housing where you're just quite literally acting as an apartment building but focused on those students? What are those dynamics?
Yeah, what I've seen from our portfolio is more the latter. It's going to be a like one of our sponsors, Multiversity. They are a specific student housing owner operator. So they go out and find student housing buildings. And I think I never lived in true off-campus student housing, but there are some different operational dynamics that are required for running and managing a student housing building, right? The leases are potentially
Absolutely.
shorter. Yeah,
Mhm.
like how many people you can shove in a building.
Right.
Um, so for us, it's the latter. It's not as much contracting and more on the, like more like a value add apartment, but a subclass of apartment.
Hmm. And yeah, do you have any information on how student housing compares or competes to traditional apartment investing? And I'm just curious because it's like, with a traditional apartment building, you raise rents, right? I don't know, it feels a little more like there's some parameters in student housing that limit some of your optionality.
Yeah, I think on one hand you could say you're competing with the rest of the market, you're competing with the rest of apartment. On the other is that it's not that you form a cabal, but within a certain radius of the campus. I went to USC for my master's degree, and within probably like a 4 or 5 block radius, it's mostly student housing, and there's some smaller
Mhm.
landlords, but there are a lot of kids who want the on-campus experience, not on campus. So they want the same sort of amenities, maybe being where they know all their friends are going to be, and not have to sort of rough it yet for themselves. And there's a
Hmm.
lot of, I think, the parents working with these off-campus landlords to understand, what their kids, what's happening with their kids. They're more understanding of that guarantor system. And typically, you're going to have some sort of proximity to the campus that a lot of kids are going to want, which they'll pay a premium for to have that on-campus experience, but being off-campus.
Sure. On the self-storage front, I know there's multi-billion dollar companies, right? There's public equities you can invest in that are massive storage companies. Are you working with some of these mega companies on, solo projects or individual properties? Or are you more working with kind of sole proprietors and small, medium-sized self-storage businesses?
Yeah, for the most part, we've done most of the big ones. We've done public storage, we've
Oh,
done
well.
extra space,
Hmm.
um, and it's I from what I recall, from what I understand, the market is less about, you know, um, you're building it for them or they're buying it. It's more like a flag model, right? Like the hotels. So you have a hotel, you reflag it under Choice or Marriott. And it's not that
Mm.
Marriott owns the hotel, but it's more like a franchise system.
Hmm.
And same thing, the extra space storage that we have in Texas, McAllen. It was Life Storage reflagged as Extra Space. I think Extra Space bought Life Storage, but regardless, now Extra Space. And there's some sort of deal to use their name and their system, and we collect the rents on people putting it into the buying their slips or doing the moving and shipping business that they have there.
Hmm.
But yeah, we are partnering with the more name brand things, not so much local companies for self storage.
Got it. That's really interesting. Last one on the car wash front. I mean, this is a phenomena that I'm kind of curious to get your thoughts on why it's happening, or if you've read any market research on why the car wash industry does seem to be really booming. I don't know if it's car sharing or what. I see them all over the place. But can you talk to some of the trend lines and reasons why you think the car wash industry is growing so quickly right now? And then are these all new build investment projects that you're doing?
Yeah. So speaking to the demand, and this again gets to Car Wash Magazine and the reports that we look at. There's a significant number of people that have just been trending towards getting their car wash not at home. Now, some of that's I think people don't have as much space, right? If you live in an apartment in a major metro area, you're not going to have a place to wash your car unless you go and do it.
Yeah.
Some of it's, I think, people transitioning more towards just leaning into the service economy, right? People drinking coffee at home, I think, has declined, and this is probably the same rate as people getting their car washed at home. And there's also just the convenience, right? There's a big push for car wash roll-ups over the last 10 years or so. So it's become a much more economical model for private equity companies. And some
Hmm.
of that is the push towards things like monthly subscription plans. So you'll buy the Platinum Plus subscription. It comes with however many car washes per month and maybe like one detailing package. And of course, you're going to do the math and say, oh, like I'm going to get my car washed twice a month, and this thing I get 5 car washes for the price of three. I might as well, and I'll just get my car washed an extra time. Um, so it becomes much more stable business
Hmm.
model for these companies. And I think that the last one for making it an economical investment, aside from the demand drivers, is the Tax Cuts and Jobs Act, now extended through the One Big Beautiful Bill Act. There was a significant portion for real estate, obviously, and then there's also a subsection of that real estate carve out, which, if I understand the bill correctly, made wastewater treatment properties tax advantage or with
Hmm.
additional bonus depreciation. So, a car wash is not what you would consider a wastewater treatment facility, but it does have wastewater treatment equipment, and that equipment can be depreciated at a much faster rate than it was before that act.
Interesting. Very interesting. Last question before we get to some crowd questions here. In terms of fee structure, what does that look like on these individual deals that you can invest in?
Sure. Equity multiple, we make money three different ways. There is obviously the ongoing asset management fee, typically around 1% for most of these assets. It's never been over 1.25% from any assets that I've seen. For equity investments specifically, there's also the promote or the carry. So for that, it's typically going to be between an 8 to 10% hurdle rate. So annualized return of 10%. There's no promote. Anything above that's usually between an 80-20 to a 70-30 split for the investor to equity multiple. And then there's also a fee paid by the sponsor to list their investment on our platform. That's capitalized to the deal, not paid by the individual investor.
Got it. All right, let's get to some of the questions that are coming up here. So the first one is, between these six assets, campground, hotel, medical, and so on, which one is the riskiest?
Yeah, it's difficult to say. I would say hotel probably is the most cyclical. That's going to be really beholden to the area. The amenities, they age out fairly quickly. I don't know if you've ever been to a 10-year-old hotel, but it feels like a 10-year-old hotel. And then also going to be really beholden to the market cycle. Hotels make money both by business travel and then also individual, like vacation,
Mm,
personal travel. So if nobody's traveling business, which they weren't for the last 5 years, hotels really took a hit. And anytime that there's some sort of fear of recession or fear of travel advisory, people are going to travel less for personal reasons, and that's going to hurt hotels as well. It's mitigated by maybe looking at more core markets or growing markets that are seeing sustainable demand due to some sort of presence. So in Nashville, we're looking at we're currently investing in a Marriott hotel
mm,
building development. And I don't know much about Nashville. I know that there's the country music and all that. But there's apparently a very large Amazon centers there, corporate center
mm,
there. So that's covering your corporate travel. Amazon's going to be fairly stable, and there's probably going to always be people cycling in for corporate presence. And then obviously it's got the hospitality, and it's a big heart of borderland to the south as well. So there's a lot of people traveling there for hospitality. So with that and the trend line that we're seeing with population and other hospitality growth there, it made sense. And just not having the type of hospitality building that we would typically see in that area. It was underserved, or there wasn't enough supply coming online. So being early to the construction there is advantageous for us.
hmm. Very, very interesting. Next question here: is student housing really a good investment? It seems that there's a high tenant turnover and the student population is often looking for low prices.
Yeah. So the turnover, of course, because students are there, they maybe stay in one student housing building once for 1 year. But there's traditionally been a stable supply of students for a lot of
Right.
universities. Now, if you're looking at small liberal arts college towns, Wheaton in Massachusetts, or anything like one of those small colleges, that's probably going to be a more difficult play. But if you're looking at Cambridge, if you're looking at Atlanta, any of the large college towns, some of the big Texas ones, you're going to get a fairly good stream of student renters. And you mentioned price consciousness. When I was a kid in college, I certainly was price conscious, and we did fit probably five people in a one-bedroom apartment in New York. But there are certain kids which are not as price conscious, and as I mentioned, they want that experiential living experience. So I mentioned USC, even for here in the city, there's more kids living off campus than on. But you're going to always have that class of kid who wants to live in, a dorm style apartment with their friends, with the amenities that they're looking for and willing to pay that premium. The student housing premium for USC was significantly higher than the off-campus, like true apartment buildings that you would live in. And then there was also a significant wait list. So there are people signing up for apartments in Los Angeles the year prior to when they would need to be an off campus. I think most kids stay on campus for freshman year and then they go off campus in one of these places for sophomore year. So the risks of that business model, as we all have seen, is a decline in in-person university attendance. And we saw
Mm,
that with COVID, and the trend continues a little bit for colleges and universities that couldn't recover from the to their pre-pandemic levels.
mm.
So there are some interesting dynamics there. It's not I would not put the kibosh on a student housing deal off the bat just because it's a Stuho deal, but I also wouldn't give the approval to a student housing deal just because it's a student housing deal.
No, I agree. I mean, honestly, I remember when I was in college, you had to live off whatever junior year. The truth was you had to pick your apartment by October because it'd sell out.
Yes.
So the stable of supply is actually exceptional. There's probably more operational lack of enjoyment of running that business, but you're a sponsor. You don't care about that. Ultimately, it's actually probably a nice, fairly stable business. Um, that's very interesting. Which of these six categories has the lowest payment default rate?
Lowest payment default rate. Interesting. I'm unsure of that, actually. I don't have the data right in front of me. And, we've not done a lot of recent debt for some of these. Um, I know that the simpler the business plan is typically going to make it, in my view, it would make it less likely to default. So something like a car wash, something like self-storage. The campgrounds and hotels are on the hospitality side of the business, and you can do as much, mitigation and cash flow smoothing as you want to try to get differentiated revenue streams. But at the end of the day, they are fairly cyclical. Food and bev and the actual rents or the fee for staying at the hotel is going to be, fairly correlated at a hotel and or at a campground. I think medical office maybe just in the general office category, you saw a big spike. But I think the general rule of thumb is more simple business is, in my view, going to have a lower risk of default than a more complex or cyclical business like hospitality.
Can you speak at all? Because I think a lot of these questions are getting at, these are asset classes folks haven't touched before, not nearly in the same way that they have other traditional real estate assets. Um, when we think about IRR on these, recognizing that, there's more risk or maybe just more unknown, can you give us a sense of what IRRs may look like in deals like these?
Yeah. Yeah, I think we've tried to target deals because we know that they're more attractive when they're above the mean. We're always targeting deals that are going to be in the 20 plus IRR range. For the preferred equity and the senior debt side, we've been looking at deals that are in the 12 to 15% range.
Mm.
For a lot of these. I think we had a senior note on this express car wash in Compton that we built or lent to build, and I think that the gross yield on the note was about a 14.
Uh,
Hotel development in Nashville that we're looking at, I think the net IRR is about a 24 or 26. Self-storage was in the mid 20s, and then we haven't done a student housing deal in a little bit here. But I think the target IRRs again were in the mid 20s for those. So very similar,
amazing.
yeah, very similar like IRR targets to our traditional core four, but
Mm.
they're going to come with different splits between the capital appreciation versus the cash flow.
Wow. I mean, that's pretty impressive. Um, Does equity multiple allow users to invest in diversified ETF-like funds of each of those asset classes, or do investors have to select on a deal-by-deal basis?
Yes. So we right now we don't have any funds or ETF type products available for these specific asset classes. We do have a debt fund, which has a mixture of different asset classes, has some hospitality, some apartment, some condo conversion. I think there is a couple of hotels actually. That's all senior debt though. So that's a single investment. You get diversified, and it pays a quarterly coupon. We also have done truly diversified funds. So again, it's not going to be a campground fund or a hotel fund, but it's going to be a broad, very diversified set of properties across various asset classes. We can get it maybe to in a second, but I also, if our people are interested in hearing about a live deal, I can talk through that, which is actually a manufactured housing fund. But right now, no, we don't have anything other than that Ascent Income Fund or the Manufactured Housing Fund available.
Got it. Are institutions investing alongside retail in these offerings on your platform, or is it all smaller investors?
So with the equity investments, you're going to have, or we expect the sponsor to have about 10% equity investment as well. So that GP stake is going to be 10% of the 10% of the investment amount for the equity. We also will have sometimes deals where part of the GP are a large family office or a larger institution. And there are times, most of the time, we're going to want to be the majority of the equity in a deal. We like the control that affords us, that allows our asset managers to do a lot more on the property. And, we see it as a risk mitigating factor. But there are times where we're minority equity. And in those cases, we're investing in much, much larger deals, large family offices, large developers. I think, one of the largest ones we were investing with was a large wealth manager out in the Midwest, who had a lot of wealthy families investing alongside of us. So there's a mixture, but we do prefer to have the majority control on all of our deals.
Got it. Well, how about we go through that example case, and then if you could tell folks where they can go if they want to get invested in these things.
Yeah. So this is the latest offering. We just launched this last night. This is a manufactured housing fund. So it kind of hits on a couple different themes. You're getting something different than apartment. You're getting something different than multifamily or single family rentals. You're getting at a secular trend of affordability, and then you're also getting it in the fund. So a lot of investors, I think, starting out, they like the idea of investing in real estate. They like the more certainty or security of investing in like something like an ETF or investing in a diversified stock portfolio. So I think that this gets to that is, for just the investment of 25,000, you can get into a existing, it's already running manufactured housing fund with a really quality operator. It's also, we're investing in the preferred Class A shares, so you're getting more downside protection. And as I say, it's really attacking this affordability crisis for workforce housing in terms of manufactured housing, providing that ability for people to have a place to live and an experienced place to live. And it's also, I mentioned roll-ups for car washes. This is also sort of a roll-up for manufactured housing lots. So it's going after family-owned and operated properties, rolling them up, getting that efficiency. And it's got some fairly strong cash-on-cash target returns. I think high singles to low double-digit total stabilized cash-on-cash. And the return potential for this, I think we're targeting about it's a 14 to 20% total return IRR, but a very short hold period. I think on the offering page it says 2.7 years, which is a strange choice of units, but less than 3 years is what we're targeting for the hold period.
Excellent. If folks want to get involved and they want to invest, where should they go? What should they do?
Yeah, so I think that there's a link in the webinar for my calendar link. You can click on that. You can schedule time with me. For everyone else, you can go to just EquityMultiple.com. You can browse around. If you click to make an account, all it takes is your email and your name, and then you can view these offerings live. To invest, you have to obviously create an investment account. You have to be an accredited investor. But you can also reach out directly to me using my calendar link or ir@equitymultiple.com. And again, obviously the website is equitymultiple.com. All the information is there. Schedule a 30-minute call with me. I'd be happy to talk through in more detail. And really, excited to talk through all these asset classes today with the crew here.
Outstanding. No, thank you so much. And I highly recommend, if you're interested in this at all, definitely find time to chat with Daniel, because we've had some awesome conversations. And there's few people I've met that know more than him when it comes to all this stuff. So I think it's a worthwhile conversation and you'll learn a lot, regardless of whether you invest now or later or whatever it may be. But Daniel, this has been fantastic. Thank you so much for sharing this with us. I love finding parts of the market that are underserved or that folks aren't looking at or getting access to. And I think it's so cool that you're creating this connection point to all of these unique asset classes within real estate that just are completely inaccessible to everyday individuals on a general basis. So thank you very, very much for what you've done here today. Thank you everyone for tuning in, for your wonderful questions. And please, as always, reach out if you found this helpful, and let us know what more you would like to see on educational webinars like this. Daniel, thank you again. Have a wonderful day, and have a wonderful day to everyone for attending. Thanks so much.
Thanks, everyone.